Hello, everyone. Thanks for joining us today. This is Jerry Bekaert's panel discussion of the Payroll Protection Program loans, an update on those programs, and also what's new with the Employee Retention Credit. Both programs got a real juice and new life when the President signed the Consolidated Appropriations Act back at the end of December. And now that there's some new guidance and some new information, and we've been working with these new rules for a bit, we wanted to bring our specialists in to talk about the programs and what we've been learning and experiencing, and answer some of the questions we're hearing from you, our clients and friends and colleagues. So today I have joining with me Deb Walker, who is our National Director for Compensation and Benefits, Tax Planning, John Carpenter, who is in our advisory services, and John and Deb jumped on the PPP loan program very early on. Daniel DeSonia and Evan Ursery have been key players in our PPP loan assistance and resources. Martin Karaman and Deb will be talking about the Employee Retention Credit, this tax credit against payroll taxes, which has been renewed and improved. And we have one more player you'll see at the end, Ann Yancey, who's not able to join us today, but she'll be talking about, is a resource for that Employee Retention Credit as well. Today, we've sort of mapped out how we're going to discuss things. First, we'll be focusing on 2020 activity, the original PPP loan 1, as we refer to it, what's happening we see with audits, and also the 2020 Employee Retention Credit, or ERC. Then we'll sort of move into what's new for 2021. That is those second draw PPP loans, some shuttered venue grants that are out there, and then what's new with the Employee Retention Credit, ERC, in 2021. So Evan, I'll turn it over to you and let you and John and Daniela talk about PPP 1.
Awesome, thanks, Sarah. So how we're going to kind of shape this is I'm going to ask some questions to John and Danielle, some kind of frequently asked questions, and then I'm going to go forward. So John, if I didn't apply for a first draw PPP loan in April, can I apply for a first draw loan in the latest legislation? And then how do I qualify for a PPP 1 loan?
Sorry to get my microphone right. Yes, any business or nonprofit that did not apply for a first draw loan back in the April, May, even June timeframe is eligible to apply now. And the eligibility criteria is really largely the same as it was back in the spring. Primarily, the borrower and their affiliates have to have under 500 employees. And don't forget that, just as was the case back in April, May, borrowers need to make their certification that because of the economic uncertainty of the situation, that they need the PPP loan to support ongoing operations. That certification was in place on day 1, and it continues now.
Awesome, thanks, John. Danielle, so how long do I have to apply for a new PPP 1 loan? And then how do I calculate that loan amount?
Sure, so you have, as of now, up until March 31st to apply for a PPP 1 loan, unless the funds run out before that. Now, we think if the funds run out that they're going to allocate some more, but that's not guaranteed. However, the way it's tracking right now, we don't think they're going to run out before the end of March. So I think you're good on timing there. So there's no need for a mad rush to apply today if you haven't. You need time to get your documents in order and contact your lender to see if they're currently accepting applications. So to calculate your loan amount, it's largely the same as it was last year when we were going through this for the first time. And it's essentially 2.5 times your average monthly payroll, no matter what industry you're in. We'll get into the different industries later, but everybody is 2.5 times your average monthly payroll. And that can mean your employee cash compensation, your owner compensation, your employer paid benefits for health insurance or retirement benefits. So again, not a lot of changes there as far as this round of PPP 1 and then the last round of PPP 1.
Awesome. And Danielle, you mentioned some documentation. What are the documentation requirements for a PPP1 loan?
Yeah, so it's basically just documents to prove those costs that we just talked about. So for your employee compensation, there's several things. You can do your Form 941, so you can give Q1, Q2, Q3, Q4. You can do the bank your W-2s, W-3s, anything to show 12 months worth of data so that they can get your monthly average. If you're seasonal, it varies a little bit there. You do 12 weeks. For owner's comp, it depends on your entity type. You may be your Schedule Cs or your K1s. And then for the benefits, you need to prove that you could do several different things, or you can give your invoices or account statements from your benefit provider. But the easiest thing to do would probably be, again, tax returns, depending on which type of entity you are.
Okay, awesome. John, what's the maximum loan amount that I'm able to receive for a new draw PPP1?
10 million is the max. That is the same as it was right from the beginning. And I know when we talk about PPP2, we'll highlight that there is a difference there, but still 10 million is the max for any one entity.
Okay, perfect.
And
Let's switch gears.
Evan, I'm going to add on to that. What we didn't talk about when I talked about the calculation was that same as last year, every individual employee or owner is capped at $100,000 annualized, which means over 2.5 months, they can only include $20,833 of payroll per employee. So that goes into your calculation as well. Okay,
thanks, Danielle. So gonna switch gears a little bit from the application phase to the forgiveness portion of this new draw of PPP1 loans. Danielle, in this new funding, do I still have a choice between 8 or 24 weeks from a forgiveness perspective?
Yeah, so you can choose 8 or 24 or anything in between now. So last year was kind of a big deal where you could only choose one of those two. And we had a lot of borrowers that said, hey, but I'm going to use everything in 12 weeks or 15 weeks. But they were still technically selecting 24. They since changed that. So your covered period to use all of your funds is anywhere between the 8 and the 24 weeks.
Okay, awesome. And John, were there any changes in the forgiveness process in the Economic Aid Act? And are there any new costs that we can add?
Yeah, the Economic Aid Act made a couple of changes. The most notable one is that on the smaller end of the spectrum, borrowers whose loan is under $150,000, they now have a much simpler forgiveness process. They redesigned the form 3508S, and so borrowers with loans under 150,000 now have a very simple form to fill out. There is no supporting documentation that has to be provided. And this we're talking here for the round 1 loans. We'll talk about round 2 later on. And it's really up to SBA over time to decide how they're going to audit those loans. There is with a lot of people, there is a misconception that if your PPP loan is under 2 million, that you're not subject to audit. That's not true. Treasury has said if your loan is over 2 million, you're guaranteed to be audited. But if it's under 2 million, you're still subject to audit. It's just clearly the government, SBA, no one is going to be auditing every loan. They'll have some selection process. So the forgiveness process for the under 150s is very simplified. And the other change they made, as you reference, some new costs. At Congress's direction, borrowers can now include some additional costs for forgiveness that weren't eligible before. On the benefit side, notably, employer portion of life insurance or disability is now eligible. Employer portion of medical, dental, and vision has always been eligible, but now you've got life and disability eligible. And then there's certain other non-payroll costs that are now eligible. The costs of cloud services, the costs of if you use an outside payroll service, those costs are eligible. If you incurred costs related to modifying your workspace to make it safe, related to COVID protection for workers or customers, those costs are eligible. Certain supplier costs, especially perishable goods, are eligible. Other supplier costs that relate to a contract that was in place before your PPP loan, those are eligible. If you had any uninsured losses resulting from any of the civil disturbances in 2020, those are eligible. A couple of minor things, but those are the main ones.
Thanks, John. And Danielle, from what you've heard from our work with the banks, how has the forgiveness process been going from a bank's perspective on the first draw loans?
That's a bit of a loaded question, but it's going. It's the SBA portal opened up about mid-August, and some of the banks were right behind them. Some of the other banks didn't open their forgiveness portals till October, November, maybe even later than that. So some banks have been going at it for 6 months, some a lot less. It's just a large volume to get through for these banks. You know, they're limited on resources and time. So they have been able to, accept the forgiveness application, submit it to the SBA, and a large number of loans have already been forgiven by the SBA. However, there are some audits. There are some times the SBA asks for more information, so that's not unusual. I will say that, it seemed like the banks were just hitting their stride. Things were slowing down as far as changes, and then they introduced this next round. So a lot of the banks that we work with have turned their resources to the origination of the new loans. So the forgiveness has sort of slowed down. And we even know of a couple banks actually stopped accepting forgiveness applications. So if your bank has said, hey, you can't even apply right now, that's not unusual. And I suspect that once they get over this hurdle of originating a bunch of new loans, that they will open back up and allow you to apply. So it is going. It is possible to get your loan forgiven in, the 60 days that the bank has and then the 90 days that the SBA has. However, it's not unusual for it to take that full, 150 days.
Awesome. Thanks, Danielle. Sarah, do you mind going to the next slide? All right, now the PPP1 loan audit process. This is kind of a question for John and Danielle. Have you experienced any communication back to the bars from the SBA? How's that process taking place, and can you provide some examples to that?
Sure. I'll start by saying, for anyone out there who has a PPP loan of $2 million or greater, and or combined with your affiliates who got PPP loans, if the total loan exposure of all affiliates is over $2 million, then you will be required, if you haven't already, to complete some kind of a loan necessity questionnaire. There are two different forms. There's a 3509, which applies to any for-profit business, and a 3510, which applies to any nonprofit. If you haven't looked at these questionnaires yet, and you fit in the category of being a larger borrower, we would encourage you to look at those very soon. The forms are out there on the SBA website, very easy to find. But these questionnaires are fairly lengthy. I'll say they're fairly intrusive. There's a lot of questions there about revenue activity during the covered period, distributions made, compensation paid above $250,000 annualized, a lot of other operational questions. These are not quick and easy questionnaires to fill out. Most clients we're talking to, when we ask them how long it's taking to fill out the questionnaire, the answer is usually days, not hours, days. The SBA never really has come out with a very defined process of how the questionnaires are going to be disseminated and returned. So it's frankly a little bit haphazard, but I'd say generally what we're seeing is that for borrowers whose loans are over $2 million, once they apply for forgiveness, once it goes through the review process at their lender, then it goes to SBA. Somewhere after it goes to SBA, that's when the message is being relayed from SBA to the bank, to the borrower, saying, you need to fill out this questionnaire. Once it's received, borrowers only have 10 days to fill it out. That's not very long. So that's why we encourage people to start working on those sooner than later. And we have seen some examples where once the questionnaire goes back to the bank, back to SBA, we have seen some follow-up letters or correspondence come from SBA, again, routed through the bank back to the borrower saying, well, we reviewed your questionnaire and now we want more information. And I will say that, you know, at least in our experience of the lenders we're working with, once all that information goes back to SBA, there's not much movement happening, frankly. The good news is we're not seeing any loans declined. We're not seeing forgiveness rejected because of a questionnaire, but we're not really seeing it approved either. There just seems to be a large backlog of forgiveness applications where nothing's being heard, nothing's being decided. So I'm sure at some point the log jam will start to move, but right now it's not moving, honestly.
Awesome. Thanks, John. Now we're going to switch over to 2020 ERC credits.
Right. And Deb, can you give us a big picture overview of this, of the 2020 employee retention credit? You're still on mute, Deb.
The employee retention credit is a payroll tax credit, which means it's available to tax exempts as well as trades or businesses. And there's no size limit as there is with PPP. The important thing is you have to be an eligible employer. And we'll talk a little bit about that. The eligible employer definition is the same for the 2020 retention credit and the 2021 retention credit. And when you determine, there's two ways to be an eligible employer, because you're partially shut down or completely shut down by a government mandate, or you have a drop in gross receipts. When you're looking at who is an eligible employer, you do need to look at the controlled group. And the controlled group rules, you have to just basically work through parent subsidiary rules and brother sister corporation rules, applying a more than 50% ownership test. It applies to trades or businesses, so it does, but you do need to take into account the entire controlled group. And generally, there's no real way to know exactly how many employers you have in a large controlled group unless you continue to work through it. And then for 2020, it's a 50% credit on up to $10,000 of wages paid during the year. That gets a lot better in 2021, as you will see.
So Deb, this is a payroll tax credit. We're just issued W-2s for 2020. Isn't it kind of too late to go back and claim this credit?
Well, that's a great question. The credit is claimed on the employer's employment tax return on 9/41. It's a quarterly tax return. So it's not too late to claim the credit. 2020 credits apply from March 13th through the end of 2020, and you claim it on a quarterly tax return. The March wages, the March credit, as well as the second quarter credit are all claimed on the second quarter, 9/41. Third quarter wages are on the third quarter, 9/41, and fourth quarter wages are on the fourth quarter, 9/41. So you can do amended payroll tax returns. It won't involve W-2Cs. It'll just involve the employer's payroll tax return. And those returns can be filed up to 3 years after the payroll year ends. So we have plenty of time to do that, but most people want their credit quickly.
Well, Deb, why should people look back now? I mean, what's changed that makes the 2020 ERC more available?
The ERC, the law that was passed on December 27th, made the ERC available to PPP borrowers. So now we have all the PPP borrowers that can go back and determine if in fact they were eligible employers, and then that the wages that they, as long as they didn't use the wages for forgiveness, they can use the wages to claim a credit. And we'll get into a little bit later how you figure out what wages you used for forgiveness versus the credit.
Great. Marty, Deb had mentioned that a qualified employer would have to be subject to some sort of government shutdown or show their business has been affected. Can you fill us in a little bit more about what kind of examples you've seen of those kinds of government mandates?
You're on mute.
Yep, hold on. Try again. There we
Yeah,
go.
how's that? Okay, so just to level set, yeah, we're gonna always, as Deb mentioned, first look at that gross receipts test. To the extent that doesn't apply, we're gonna take a look at what we refer to, I think, internally as the government mandate test, and that requires there to be at least a partial shutdown on the business. Specifically, we're gonna look at the orders that were issued back in 2020 and that still exist today that limit commerce, travel, or group meetings due to COVID-19. What does that mean? We think about all these orders that are out there that were work from home orders or capacity limitations. But I'll go through some examples just to give you a sense of how you can think about this more practically. Because it does not have to be a complete shutdown on your business. It really needs to be a partial shutdown, which I like to think about as some disruption to the business that has a more than nominal effect. Let's think about something like concert venues, movie theaters. Obviously, we're thinking a total shutdown last year because so many have been closed. But I think a lot of people start to think about work from home orders then. That on its own is not enough to the extent people go and work from home because they have to, or maybe their company voluntarily requires them to, but to the extent they have to, and I've worked with some R&D companies that couldn't get to an R&D testing facility, so they couldn't do the work from home. I've worked with some software companies where the employees didn't have connectivity appropriate for the cloud environment in which they were working. That would also be deemed something like a partial shutdown. I have seen it in the sales and marketing context where our sales and marketing people for companies have these large conferences that they attract a lot of clients every year. And that was something that was set up, probably soon after COVID started to hit. That has been thought of as a potential partial shutdown as well, due to the fact that suddenly you have all these sales and marketing people who can't do their job. I've seen it in manufacturing companies where they've had certain lines shut down for a period of time. Obviously, restaurants, we see capacity limitations and just being limited to takeout. I've seen it at hotels, which have capacity limitations as well in terms of how many people can be in the rooms. I've seen it at staffing companies where they have to go, the company staffs certain businesses, and those businesses get shut down, and that staffing company's business essentially is directly affected, although the order is not on them, but it is a direct impact on their business. And I will say this, I've seen it also with essential businesses. A lot of companies think, well, I'm essential, this doesn't apply to me. Probably true, but maybe not, due to the fact that I've seen it, and you can see this in the FAQs as well that the IRS put out. To the extent you're an essential business, but you have, specifically in the manufacturing context, if you have a supply chain disruption where your suppliers are disrupted, that is deemed to affect you directly enough that you have a partial shutdown. Last point here is just because people were staying at home and you have a lack of customers coming in, that's not going to be enough. That's an order on somebody else. That's not on you. And the hope then is that you would use the gross receipts test. But that's some examples I think that are helpful for people to think about.
That's great. So really, that sort of wraps talking about 2020 and the credit. I think now, Evan, we're going to shift our focus to what's going forward in 2021.
Yep. Thanks, Sarah. So Danielle, what's the difference between a first draw and second draw PPP loan? And then can you tell us like the difference between the calculations for that?
Yeah, sure. There's a couple main differences. If you remember from earlier, John said that between you and your affiliates, you're kind of capped at 500 employees. This round, they lowered that to 300. So a little bit smaller. They've also lowered the maximum from 10 million to 2 million. So if you end up doing your calculation and you're eligible for 3 or 4 million, you're capped at that too. There's no exceptions there. The other main difference is for the hospitality industry. So if you are part of NAICS code or industry code 72, which is your restaurants, your hotels, everything hospitality, most things hospitality, you can actually get 3.5 times your average monthly payroll rather than 2.5 times your average monthly payroll. So they saw the need there for this certain industry to have a little bit more help, and they give them that help for PPP too. There's some other small differences I'm sure I'm forgetting, but those I think are kind of the main three. As far as the calculation goes, it's the same. So again, you're taking your average monthly payroll supported by all the same documents that we discussed previously. However, this time you can use 2019 or you can use 2020. So, 2019 may have been a better year for you. You may have higher payroll that year, or not. Maybe you have higher payroll 2020. So you can look at which year is more beneficial and use that year to calculate your average costs, which in turn, calculate your loan. The key to remember there is if you're including those employer paid benefits, that those have to match the year. So if you're giving us 2020 cash compensation for your employees, you also have to give us your 2020 benefits. You can't mix and match years there. Same thing with owner comp. You can't give us 2020 owner comp, but 2019 employee comp. So largely the same as far as the calculation goes, other than NAICS code 72.
Yeah, and the one thing to note there as well is you can use the trailing 12 months. So for example, you can add in January 2021 and exclude January 2020 in your calculation.
Exactly. If you're not going with a calendar year, it has to be the most recent 12 months. We have seen people try and start in April 19 and go to April 2020. You can't do that. It has to be calendar year or the most recent 12 months. You're right.
Okay, awesome. Thanks, Danielle. And John, how do I qualify for a PPP2 loan?
Your qualification, what has changed in round two, number one, you have to have gotten first draw loan. So if you did not get PPP 1, as we said a little while ago, you can get a first draw loan now. But first of all, you have to have had a PPP 1 loan. And then the bigger hurdle, I'd say, for a lot of businesses is that they must demonstrate a 25% reduction in gross receipts for any calendar quarter in 2020 compared to the same quarter in 2019. That 25% is a hard number. Sorry if you have a reduction of 24.9%. That there's no rounding up. It has to be 25% or greater. It does have to be measured on a calendar quarter. If your business has an April 30 year end and your fourth quarter is February, March, April. No, you have to use a calendar quarter, and you don't get to choose a quarter like, oh, well, my bad quarter was April, May, June, July, and it has to be a calendar quarter. So that's really the big new changes. You have to demonstrate that revenue reduction or the receipts reduction, and then as Danielle mentioned, the smaller head count. Those are really the big changes in this second draw.
All right, thanks, John. So Danielle, what are the documentation requirements for the new PPP2 loans, and how long do I have to apply?
So just like with PPP 1, you have until March 31st, excuse me, unless the funds run out and they don't reallocate funds. As far as the documentation goes for payroll, like I said, same deal as PPP 1. However, as John just mentioned, we have to prove that we had this 25% revenue reduction from quarter to quarter using the same quarter in 19 versus the same quarter in 2020. And that support is simply P&Ls from your QuickBooks or whatever your GL software is. If you don't want to do that, or you can't do that for some reason, you can do annual, but you must give your tax return. So it has to be a tax return versus a tax return, which obviously makes it tricky because most people have not filed their 2020 tax returns yet. The 2020 return doesn't have to be filed, but you are certifying that it is, accurate. So the signed quarterly P&Ls are the best way to prove that revenue reduction. And then you have to prove that you were in business on 2/15/20, which can simply be done with a payroll register or your Q1 2020 941. So a couple additional things, but as far as the actual calculation goes, no difference.
Awesome. From a forgiveness perspective, do you still have a choice of 8 or 24 weeks, or how does that play out going forward?
Yep, same thing. So you have anywhere between 8 and 24 weeks now. And I'll just point out here that I think we had a question about when you have to apply for forgiveness, and that is still technically no deadline. However, your principal and interest starts kicking in 10 months after the end of your covered period. John, that's still accurate, right? 10 months? Okay.
That is correct.
Yep. So again, no real deadline there. However, if you want to avoid starting your P&I, then you're going to want to apply within 10 months from the end of your cover period.
Yeah.
Awesome. So
Effectively for most people, if you think about it, most companies or nonprofits who got their PPP loans, many in April, some in May, those covered periods were generally in October, maybe into November. So really that deferral of interest and principal extends really all the way till about early August of this year. So there's still plenty of time.
And one more thing, we have a lot of borrowers ask us if they have to apply for forgiveness for PPP 1 before they apply for PPP 2, and they don't. I think there's a little bit of misconception there, some confusion. You just have to certify that you did use all of your PPP first draw, or that you will use all of your PPP first draw before you get your PPP second draw. So you do not have to have any official approval from the bank or the SBA for your round 1 before you apply for round 2. It's simply a certification that you've used it all in eligible costs.
awesome. So Danielle, what's the maximum loan amount that we can get for PPP 2?
Yeah, but I think you mentioned this before. Again, it's down from 10 million, so it's 2 million this go round, and it's the same $100,000 annualized cap per employee.
Okay, awesome. And John, do those same new costs still apply to the PPP 2 second draw loans?
They do. Everything we mentioned earlier, the certain supplier costs, employer portion of life and disability, all those things are eligible uses of PPP2 funds, just like they've been modified for PPP1.
Awesome, thanks, John. Sarah, do you mind going to the next slide, please? Okay, awesome. These are some PPP2 loan non-qualifying factors. So if you have any of these qualifications, you cannot apply for a PPP2 loan. The main one is the public companies and companies who have more than 20% or greater ownership in China or Hong Kong. And then also companies that are applying for the Shuttered Venue Operator Grant, which we will discuss next. Sarah, do you mind going to the next one, please? Thank you. John, so can you provide some examples of entities that are eligible for the Shuttered Venue Operator Grant?
Yeah, sure. And this is a whole new program. If anyone's wondering, well, where was this last spring? It didn't exist. This was part of the Consolidated Appropriations Act that was rolled out in December. So brand new grant program, and it's intended for operators of certain types of venues, movie theaters, concert halls, museums, talent organizations can apply, or talent promoters. So there's a variety of performance type organizations that are eligible, and these are grants. I mean, that when obviously we say on the slide they're grants. These are grants, not loans. So PPP is a loan that's forgivable. This is just a flat out grant that will be administered through the SBA, and not based on wages as PPP is. So these grant amounts, as we show on the slide here, these are up to can be made for up to 45% of the entity's 2019 gross receipts, with a max of $10 million per entity. The use of the grant money is much more flexible than PPP. I don't know if can't remember if we mentioned just here, PPP money, in order to be forgiven, 60% of it has to be spent on payroll and benefits costs. These SVO grants, much more flexible. No requirement that 60% has to be spent on payroll. Could be spent on back rent, could be spent on renovating a venue for reopening, could be spent on other supply expenses. Unfortunately, I'd love to announce that it's open, that the window is open, that everyone's ready to apply, and grants are going to start to be made here in the next couple of weeks. Unfortunately, none of that is really happening. SBA is working on this, but at this moment, the application form isn't even out, and SBA has not announced when they will start taking applications or making these grants. But for any organization that thinks they might be eligible for this, it is definitely worth investigating. We've done a lot of work in this area. We're happy to take questions or talk to organizations about it. And very important to note is that for an organization that may be eligible, they really need to think ahead of time about which one they're going to apply for, because if an organization even applies for PPP2, then they are automatically not eligible for SVO. So we really encourage organizations to take a good look at which is going to be more beneficial and make that choice before you apply for one or the other. Evan, you're on mute.
There it is. When does a business have to be established to be eligible to apply for a SVO grant?
Have to have been in business as of February 29th, 2020.
Okay.
And we won't go into the details here, but for entities that started in business in 2019, note that the grants are up to 45% of those gross receipts for the year. There's a different calculation method if 2019 was your first year in business. So we can walk people through that.
Okay. Do I need to have fixed seating in order to apply for a SVO grant?
No, you don't. Now there is language in the statute that says if you're operating a physical venue such as a theater, then there doesn't have to be fixed seating. But there are other types of organizations we think, such as symphony orchestras, things like that will likely be eligible for these SVO grants. That the organization itself may not operate the venue. We're really, I think everyone is waiting for better detailed guidance to come out from SBA before we really know who all is, which type of organizations are going to be totally eligible.
Thanks, John. I know the applications aren't available yet, but is there a deadline to apply for these grants?
No deadline's been announced. The only thing that's been announced is that, in terms of timing, is that in the first 4 weeks after applications are being accepted, SBA, the law has said that for the first 2 weeks, only entities that can demonstrate a 90% revenue decline, 2020 versus 2019, will be eligible to apply. Or actually, I'm sorry, everyone will be eligible to apply at the beginning. For the first 2 weeks, the only grants being issued will be to organizations that can show a 90% revenue decline. In the next 2 weeks, grants will only be made to organizations that can demonstrate a 70% decline. So 4 weeks from when the window opens is when grants will start to be made to entities that have something potentially less than a 70% revenue decline.
Thanks, John. So I believe we're going to switch back to 2021 ERC credits.
Great. Deb, you and I have talked about 2021 employee retention credit as really something quite different than the 2020 employee retention credit. Can you give us a big picture view of this credit? Yep.
This credit has a higher crediting rate. You get 70% of wages instead of 50% of wages. More wages are taken into account. You get $10,000 per quarter rather than $10,000 per year. And it's easier to qualify because there's still the government mandate, government shutdown rules that could apply. But now the decline in gross receipts is only 20% of gross receipts. So you compare Q1 of 2021 with Q1 of 2019. In addition, there's a special little rule that says you can use the preceding quarter. So you can look at for Q1 of 2020 and whether you can get the credit. You can look at Q4 of 2020 and compare to Q4 of 2019. Once you know you can get the credit for 2021, you can apply for it right away, just like you could with 2020, and you apply for it right away by reducing the payroll taxes you would otherwise deposit. So your federal income tax withholding, your Social Security withheld from employees or employers' share of Social Security. So it puts money in your pocket right now for 2021 through reduction of payroll taxes. And if you don't have enough, you can file Form 7200.
Is there an expanded list of who's eligible, employers that are eligible for the 2021 credit who were not eligible for the 2020 credit?
There's yes, governments were not eligible. Therefore, state colleges and universities were not eligible in 2020. They are in 2021. State hospitals and medical care facilities are also eligible. So even if certain government entities are now eligible where they were not before for 2020.
Great. Marty, you want to kind of walk us through this comparison chart of the 2020 versus 2021? I know this is not everything, but at least it highlights some of the key differences between the two.
It does. And I'll just add one point to Deb's point as well before. What we're seeing with respect to companies that qualify, if you look back to 2020, I think we're probably finding more companies that will qualify due to having a government mandate, because that 50% decline is so hard to achieve for many companies. I think for 2021, we're probably finding more companies qualifying under the gross receipts test due to the fact that only that 20% is easier to achieve than a 50% decline. So that's sort of the breakdown that I'm seeing. But yeah, I'll do this side by side. You can get a sense of what the rules are. Obviously, they're both refundable payroll tax credits, 2020 and 2021. Again, 2020, the projects that we're working on with clients are to pull together the documentation and calculations so they can get a refund from the government on the 941X. The 2021 calculations are really for purposes so we can get a sense of what the ultimate credit will be for the quarter, and then allow the client, instead of necessarily waiting for refund later and doing another amended return, to just reduce the amount they have in the withholdings and hang out of that cash now. So those are two mechanisms to hold on to the cash. Credit applicability, 2020, it's March 13th through the end of the year. 2021, it's January 1st through June 30th. The credit amount is 50% of qualified wages with a max of $5,000 per employee, because you can only include $10,000 paid to any employee in the year. It's a 70% credit, so that was enhanced, but it's 70% credit twice, because you can include only the first $10,000 paid to an employee in Q1, and then you get to start the clock again and do it again in Q2, and then it ends after that. So that's a good comparison right there in terms of what we're looking at.
Right. So, and this just kind of reiterates the same thing, but talks about that difference between 100 and 500 employees.
Yeah, I think this is a critical point. So, in general, if you're a larger company, the employee retention credit lives up to its name. It is intended for you to pay money to people who are your employees who are not providing services. So instead of having them go on unemployment or leave, you retain them. It's a retention credit, and that's what happens if you are a company as measured in 2019, but for 2020 purposes, if you're greater than 100 employees, for 2021, if you're greater than 500. The big benefit right now to so many companies is that to the extent you have 100 or fewer employees for the 2020 calculation and 500 or fewer for the 2021 calculation, is that you don't need to go into the analysis of who is not providing services and only pick up payments to them or to furloughed employees. You are actually allowed to pick up the W-2 wages paid to all employees, whether they are full or part-time. It's just a very lucrative benefit to to all the clients with whom we're talking about right now, and that's why it's expanded so much for 2021.
Great. And I think we have a quick example to walk through.
Yeah.
The facts here, and then kind of how the credit is calculated on the next page.
Yeah, I can do that. So this is a restaurant example where, and we're going to focus on the 2021 credit, where the restaurant in 2019, you measured the full-time employees, that they had 500 or fewer. And so what does that mean again? That means that if they're an eligible employer, we can pick up the wages they pay to everybody at the company, not just those who are not providing services. So they have a government order on them. And in this particular case, they can only provide takeout and delivery service potentially, not any in-room dining. But the facts go on that the restaurant pays all of its employees 100% of the wages, and they pay the healthcare premiums as well. And so we see it on the next slide, sort of how this breaks down. And what we see here is we have two employees, Chris and Deb. The 2021 wage for Q1 is $7,000 for Deb, $7,000 for Chris, $15,000 for Deb. You add on their health insurance that the company bears as well. That comes with a total qualified wage of $89.50 for Chris, and Deb $16.95. Now the limit for any person in Q1 is $10,000, and so we can only apply the full $89.50 multiplied by 70% for Chris, but only up to the first $10,000 for Deb. The only misnomer in this example is that we talked about the company being qualified all the way through the first 6 months. This calculation gets done twice. So you can do it again at the beginning of Q2. And so you calculate a $13,265,000 benefit twice.
Great. So by paying the employees the $16,950 and the $8,950 in benefits and wages, we got $13,265 back from the government to help fund that via this credit, which the employer can hang on to right now and not have to pay in on those weekly or monthly payroll tax deposits.
Yeah, and of course that's in a vacuum. A lot of companies are getting PPP too, and so we are working with them to do the analysis of making sure we're not including wages that are covered by PPP2 in this calculation. But we can work through that math pretty quickly.
Well, and that brings us to our next point here, that we're talking about, Deb, wages that are used or central to both PPP loan and forgiveness, and as well as the employee retention credit. How does that compare when looking at 2020 and 2021?
So first, let's look at it for 2020. The timeline on the bottom is kind of lays this out for everybody. In 2020, the wages paid for ERC can be any day between March 13th and December 31st. So the first and last bullets. Now, also, let's assume that this employer got a PPP1 loan, and therefore their covered period is going to start on April 22nd and end on October 6th. So those wages paid between the two blue bullets cannot be used for both ERC and PPP loan forgiveness. So what you do is you look at your ERC, the wages that can be paid for ERC only, which is March 13th through April 21, and October 7th through December 31st. And if you get $10,000 per person, then you don't have to use any of the amounts that would otherwise be used for loan forgiveness. But we recommend that before you file for the ERC, if you're not claiming maximum ERC with just the stub periods, that you go back into your PPP loan forgiveness application and determine if there are wages in that application, perhaps because somebody made more than $100,000 and you couldn't count their wages, perhaps because you didn't include healthcare costs in the covered payroll for PPP loans, and determine if there's other amounts that you don't want to include on your PPP loan forgiveness. What happens is that the PPP1 loans, which were 2.5 times wages, with a covered period that's 6 months instead of 2.5 months of wages, many people don't need all those wages. It's not clear whether if you put all those wages on a PPP loan application, you can also use them for ERC, even if included in the application were wages way in excess of what you needed for the loan amount. It seems to me you should be able to use those. We don't have any guidance now, So what we do is try and make sure that we can get wages that haven't been included. And then, of course, if we have to, we go back and use wages that might have been included on a PPP loan application, but weren't necessarily have to be used for loan forgiveness because the amounts were so in excess. But let's go to 2021, because now we have a little bigger problem, and it's much more important to track this stuff. First of all, remember Marty said that we get $10,000 of wages each quarter. So let's assume now we're into 2 quarters for the ERC, which goes January 1st to June 30th. And we've got a PPP loan in this example that goes from February 25th to August 25th for a covered period. So between January 1 and February 25, all of those wages could be used. And anything from June 30th until August 25th, all of those wages could be used. But obviously the second quarter ERC, which is going to be April, May, and June, those wages you're going to have to determine whether they should be on the PPP forgiveness application or whether they should be part of an ERC credit. It's always better to take a PPP loan because that's if you need them for forgiveness. But as John mentioned, there's lots of other expenses you can include for loan forgiveness other than qualified wages. So it's important before you file your forgiveness applications and to know what wages. The other thing is, don't forget that there's a 60% rule. For PPP loans, 60% of the forgiveness has to be in wages. So the way I think about doing it is, what's my PPP2 loan? What's 60% of that number? That amount I have to have in covered payroll costs. And in this example, it would be between February 25th and August 25th. So I know the number I'm targeting. Now I can project my wages during those different time periods and determine if, in fact, maybe I want to use some of the wages paid in late February and early March for an ERC credit in Q1, and maybe I'll use April and some of May for ERC credit in 2. The people we see having problems are the people that are with relatively low paid workforces that they don't perhaps even meet $10,000 per person in a quarter. And therefore, and they've still got a PPP2 loan. So in that case, those people are not actually going to be able to maximize the ERC because they're going to always want to maximize the PPP, which is why calculate what you need for PPP and then back into what you can take for ERC.
Thank you. That is great. As we get to our question and answer section, I just wanted to highlight for you, you can find some more resources about what we've talked about on our Cherry Bekaert website, cbh.com. And if you go to the guidance tab and search for the keyword retention, you'll find all of these resources we've talked about, the PPP loan, employee tax credits, webinar, articles, podcasts, and a copy of this session today will also be posted out there before the end of the week. So check back, go to cbh.com, click on guidance and use the keyword retention, and you'll be able to find all of these materials. So Evan, I know there's a number of questions that came in about the PPP loans. You want to field some of those with John and Danielle?
Yes, I will. There is one on ERC, as we just touched on it. So Deb and Marty, what if I only needed 12 weeks for PPP1 forgiveness? Am I defaulted to a 24-week period from an ERC perspective?
Go ahead, Deb.
For 2020 PPP forgiveness, you have one of 2 covered periods, 8 weeks or 24 weeks. The change to choose any one was only applicable to loans, applicable to loans after the enactment on December 27th of the CARES legislation of the Consolidated Appropriations Act. So you're not you would use 24 weeks, but you don't have to use every week in that payroll period. What I tell some of our when we're preparing forgiveness applications, I suggest that people just the preparers subtract $10,000 of wages from everybody's wage. Therefore, we've saved enough for the employee retention credit in 2020, as long as they don't need that for forgiveness. So I would do the same forgiveness calculation with my wages. I would get a total, and then the quick and dirty way to do it is just take $10,000 off everybody. And then you know for sure you've got enough to maximize 2020. Can't really do that on 2021 because there's so much more wages eligible for the ERC. You have to be a little finer, more fine-tuned, if you will.
Marty, there was one other question about ERC, about whether when we're talking wages that qualify, if you meet that under 500 or under 100 employee test thresholds, we're talking wages paid to all employees or just full-time employees?
Yeah, good point. I probably didn't make that clear enough. So in order to test that 100 or 500 threshold, we're looking back to average number of full-time employees in 2019. And so the count is made on full-time employees to determine how big or small you are for purposes of the way the calculation works. But then when you're actually calculating your qualifying wages, after you've determined what size you are for purposes of the calc, you can bring in wages paid to all employees in the actual calculation of qualifying wages. But the determination of whether you're 500 or 100 is done based just on full-time employees, which is generally looked at as employees who worked 130 hours in a month.
Great.
Sarah, I have one for John and Danielle. For the 25% reduction, is it a cash basis or a GAAP basis?
Mute.
You're on mute.
Can you hear me now?
Yes.
There you go.
It's going to be based on how the entity keeps its books. So we've had questions. You know, a lot of companies have said, well, I keep my books on accrual, but I file my taxes on cash. How do I measure that revenue reduction? The answer is it's going to be on accrual. So it's how you keep your books. It's not how you file your taxes. If you know, there are some companies that I'd say mostly at the smaller end of the spectrum, they keep their books on cash just because it's simpler, and then they can use cash.
So that's
ERC, right? That we're looking at cash tax, right?
for ERC, we look at cash.
Yeah.
So there's a distinction between the gross receipts test for both PPP 2 and ERC.
And Deb, they just wanted, someone would like you to confirm again that test for the first quarter of 2021 is a comparison of either your first quarter 2021 revenues versus first quarter 2019, or we can look backwards at fourth quarter of 2020 and back to fourth quarter of 2019.
That's correct. The rule is you can determine your qualification with a 20% reduction in the quarter in which you're claiming the credit or the preceding quarter, which means if you qualify in Q1 of 2021, we know that you're going to qualify in Q2 of 2021.
Right. So it's
And
a nice opportunity to know this in advance, that we're sitting right here in the middle of Q1, about halfway through, and we know what our Q1 2019 gross receipts were.
Yeah, that's just the practical approach the statute took, so you don't have to wait till the end of the quarter to figure it out, and allow you, if you need the cash, to apply for an advance immediately, or at least take into account what you're going to be paying in what you're going to be able to have to pay in employer taxes next quarter.
All right. Let's see, there were several questions about full and part-time employees and whether and who counted. And we've talked about the gross receipts. I think that covers a lot of the questions we have. We're now at the top of the hour. Evan, did you see any other PPP loan questions you wanted to make sure we covered?
Yeah, there was one more. For forgiveness of a PPP loan, are furloughs considered for salary reductions, even though hours and wages weren't cut?
Furloughs are considered. Well, furloughs are going to be considered for potential FTE reductions.
Right.
But they're not going to be considered for that salary wage reduction. That's kind of a different measurement test.
Right.
All right. Well, I think now that we have reached the end of our hour, thank you very much. We appreciate all the questions. That helps us to prepare for the next conversations we have on these topics, and I'm sure there will be more. And so check back with our Cherry Bekaert website. Also, if you want help with PPP loans, a first draw loan, an enhancement of that first draw or second draw loans, please go out to our website and click on the materials there, the links to get the resources that you need to help with that. And if you want some help with the employee retention credit, then please reach out to, sorry, I went too many slides. Please reach out to Deb or Martin or Ann Yancey, and they'd be delighted to assist you. And check out our website for more materials. Thank you all very much for your time today.